Welcome everyone to Vested Interest. This is Shane back again for the stock pick of the day video. It is December 11th, quickly wrapping up December. It will be 2024 here before you know it. Happy holidays to everyone out there. Hopefully you are getting ready for your holiday season and a very, very happy new year to everyone. I know it's a bit early, but again, it'll be here before you know it. Today we are going to take a look at one out of the energy sector, Enterprise Product Partners L.P. It's a limited partnership. Let's jump right in. If you want to know more about this company, check them out at www.enterpriseproducts.com. That's www.enterpriseproducts.com. That is their homepage where I pulled this information from. Enterprise Product Partners L.P. is a publicly traded partnership listed on the New York Stock Exchange, ticker EPD. Our origins began with Enterprise Products Company, formed in 1968 by Dan Duncan and two partners as a wholesale market of natural gas liquids. Today, our integrated energy infrastructure network provides midstream energy services to producers and consumers of natural gas liquids, crude oil, refined products, and petrochemicals. We link products from some of the largest North American supply basins with domestic consumers and international markets. So they really are a provider of oil and gas. I mean, that is their bread and butter. Been doing it since the 60s. Now, there is one thing we should touch on, this LP, limited partnership. What does that mean? It basically means rather than being a shareholder like you would of a regular company, you are considered a partner in the company whenever you buy shares, right? And that comes with different tax implications. So a company like Kraft Heinz, for example, or even ExxonMobil, which would be in the same industrial sector, ExxonMobil would. If you bought shares of ExxonMobil, those eventually would become what they call qualified dividends. So you pay a lower tax amount on them. With a LP, a limited partnership, because you're considered a partner, like if you were a partner at a business, it is considered regular income. So whatever your tax liability for your regular income will be, 20%, 30%, whatever it is, that will be your tax liability for this company as well. So keep that in mind, because it is a limited partnership. This would never, no matter how long you hold it, no matter how many shares you hold, it would never become qualified dividends like a company like ExxonMobil, right? So it's going to be taxed at whatever your taxable income is. Speak to your tax advisor for any tax advice on a company like this. Now, the reason we are taking a look at them, down 0.61% on the day, we are talking about Enterprise Products Partners, ticker EPD. Again, LP, that's limited partnership, right? So you are a partner in the company if you're buying shares in this company. Close out the day at $26.17. 52-week range as low as $23.14, as high as $27.95. So they are relatively closer to their 52-week high than their 52-week low, though there is not a big spread between the two. Average volume 4.607 million. Today was 4.65. Sell-off, almost looked like a bump up in the morning, then a sell-off throughout the day, bump up midday, maybe late afternoon, and then it tried to recover a little bit in the afternoon, but overall down 0.61%. Looks like they are continuing that downtrend in the after hours. Market cap of $56.838 billion, a beta of 1. So they are right in line with the overall market as far as volatility goes. Price to earnings PE ratio 10.64, $10.64, relatively low. Excuse me. Earnings per share, EPS sitting at $2.46 per share. Next earnings date sometime between January 30th and February 5th. They do pay out a $2 dividend on the year. They are quarterly payers, so divide by 4, though we'll see that here in a minute. Just give us a minute, we'll get to that. Very, very high starting dividend yield, 7.6%. And that is the case with a lot of limited partnerships. They are paying you aggressively as a shareholder because they consider you a partner in the company, so they are sharing the funds generated from free cash flow with their investors. Ex-dividend date was October 30th, paid out November 14th. You can see that over here, dividend date, November 14th. And one-year target estimate, at least according to Yahoo Finance, of $31.89 per share. So they see some upside appreciation. You could collect that 7.6% dividend yield while you're waiting for this 31.89. Now let's jump into statistics. I like to look at dividend yield theory to see if there is any potential undervaluation. To do that, we go down to dividends and splits. We look at their 5-year dividend yield average. It's 7.73. Compare it to their current 7.6. Here it's 7.6. And because it is lower, that speaks to overvaluation on this one. So this one needs to come down a little bit, and this is still higher. I am long Enterprise Product Partners. You'll see my shares, how many shares I have of this company here in a minute, and my cost basis. For me, this one needs to come down a little bit more to be under my cost basis. So I would agree with dividend yield theory. Whether I agree with dividend yield theory or not, dividend yield theory says this one is still potentially a little overvalued and needs to come down a little bit more. It does have a high payout ratio, but LPs often do. These are comparable to like a REIT. Typically, they pay out a significant amount of their free cash flow over the 70% I'm looking for. So at 79.47%, this would typically be over the 70% I'm looking for. But because of the type of company it is, if this was a BDC or a REIT, same thing, I'm not as concerned with an elevated payout ratio. Now we want to get into the financials of any company that we own individual stocks in. Look at their balance sheet, look at their income statement, look at their debt to equity ratios, their margin. Is their margin growing? Is their revenue growing? You know, are they paying down debt? All good information under financials. For this particular exercise, we're looking at free cash flow. We want growing free cash flow because typically if a company has growing free cash flow, it pays out growing dividends to match that growing free cash flow. So 2019, 1.9 billion. Jump up in 2020 to 2.6 billion. Big jump up in 2021 to 6.2. It looks like a slight downturn in 2022 to 6 billion, and then here to date 4.5. So it looks like we're going to be close to what we matched in 2023, if not over that. And then another one, repurchase of shares. You can see they are consistently repurchasing their shares. And part of that downturn in 2022, you'll see they increased from 213,000 to 250,000 in shares. So that could have accounted for a lot of that discrepancy there between 21 to 22. Overall, from 2019 to date, definitely see growing free cash flow on this one. Now, I always recommend more than one source. So another one that I like is stockanalysis.com. You pick any sources that you like. Just make sure you're picking more than one so you can back check the information you're getting is accurate and up to date. You can see here they updated this information on November 1st. They call it a strong buy. Not a lot of companies that I run across kick out a strong buy, but according to 10 stock analysts, this one does. And they have a low estimate of $28. It currently sits lower than their lowest estimate. And if it came back up to their low of 28, that would be a 6.99% increase in the stock price. Their average estimate of $31.50, that's pretty much what we saw on the previous page with Yahoo Finance. That would be a 20.37% increase in the stock price from where it currently sits. And if it happened to hit their high of $34, that would be a 29.92% increase in the stock price. All the while, you could collect that 7.6% dividend yield. Now, you can get in and find the same information you saw on Yahoo Finance. They just show it in a different manner, like this forecasted here. I really like these projections. The way they show it, it's very easy to understand. They go back further in the financials than Yahoo Finance does. And then statistics is another one I like too. The way they spit out that information, we're going to go in here and we're going to look at return on equity and return on invested capital. I like 10% or both on those two metrics. Return on equity sitting at 20%. Again, I like 10% or better, so it's smoking that one twice as high as I'm looking for. And I like 10% on return on invested capital as well. It's sitting at 11.08%. Beats that metric also. Now, I like to look at earnings per share growth and forecasted revenue. I like 5% or better on EPS growth forecast. This one, unfortunately, is negative 2.15, but I am not buying this for a lot of growth. I am buying this because it has an extremely high dividend yield that I believe is safe. And I don't mind companies with a high dividend yield with some issues like this. Earnings per share growth might be coming down a little bit, which I expect. We've had a huge run in oil in 2022 and 2023, even a bit in 2021. So I don't expect that run to continue as we transition away from fossil fuels. But I don't think this company, and we're not going to do that anytime in my lifetime, I don't believe, completely anyway. People will be using natural gas and oil for the rest of my life, I believe. So that transition is going to take a little bit longer. So I don't mind this. They're not going to be perfect with such a high dividend yield that you may have to give up some things like forecasted earnings per share growth, which I'm fine doing with a dividend yield that high. Now let's look at the payouts, right? It says 81.63% here. Dividend payout, we saw 79. Let's call it 80%. We'll split the difference. Either way, with a limited partnership, I'm not as concerned. Just like a REIT, just like a business development company, I'm not as concerned with elevated payout ratios on those type of companies. They do have nice dividend growth, 5.32. So not only do you get a very high starting dividend yield, you are still seeing dividend growth over time. 2020, October of 2020, 44 cents. 2021 in January, they jumped it up to 45 cents. They jumped it up again in January 2022 to 46 cents. Jumped it up in July of 2022 to 47 cents. Jumped it up in January 2023, the most recent, 49 cents. And then jumped it up again in July to 50 cents. So they are consistently raising, even though it might only be a penny or two at a time, they are consistently raising that. That's where that 5% dividend growth comes from. I would expect if they continue their trend in January of 2024, we will see another slight tick up in this one. Their payout is months are February, May, August, and November. I am long Enterprise Product Partners. I have 209.882 shares. My cost basis is $24.50 per share. So I would love it to pull back under my cost basis. If it did, I'd back the truck up and maybe jump this up to 250, 260 shares. So I am looking forward to more of a pullback on this one as soon as it hits, and I might not even wait for it to get under my cost basis. If it was to drop back into the $24 range, I would probably just add at that range. Anything under $25 on this one, I'm adding to it. So love it to pull back under my cost basis, but like I said, $25 with that dividend yield, I'm willing to pay fair price for this particular company and let the dividends stack up over time. Let that snowball really impact this one. With a 5.32% growth and a 7.6% starting dividend yield, I would almost even be comfortable adding it now, right? So that's Enterprise Product Partners. Let me know what you think down in the comment section. Really appreciate you checking out the channel. Don't forget to subscribe. Help me out with the channel. It really helps whenever you drop a comment, hit that subscribe button, hit the notification bell, share with anyone you think that might find value. Let's get the word out. In my opinion, the only way to financial freedom is through passive income, and that's what dividends provide. So help me get the word out and share with anyone you think that might find value. But most importantly, hit that subscribe button, drop a comment, and hit the notification bell. This is the vested interest stock screener. This is how I set up the videos. It's also how I look at a company on a high level to see if I'm interested in investing. You can pause this, go through it. Must meet 5 of 8. If it's a financial company like a bank, it must meet 6 of 9. And then it goes into, that doesn't mean I'm going to buy it. That just means if it meets 5 of 8 or 6 of 9 if it's a bank, then I put it on my watch list, do more of a deep dive into the company itself. How do they make their money? What are their forecasted outlooks looking like? Are they, growing revenue? Then I look at their balance sheet, their income statements, do a deep dive on the company, and then I will do a discounted cash flow analysis and see what I'm willing to buy the company at. And if it meets all the criteria at that point, then I will add it to the portfolio. I also use this as a back check for the positions within the portfolio. And if it gets way out of bounds, it might be one worth, if it only met 1 of 8, I would do more of a deep dive in the company, see what's going on. And if it no longer met my investing criteria, I would pull it out of the portfolio. Well, that is it for this one. Let me know what you think of Enterprise Product Partners below. I own another one that's similar to it, Enbridge. It's a Canadian company, does pretty much the same thing that Enterprise Product Partners do, a little bit different, but very similar companies. ET is another one. Energy Transfer is another one, very similar company. So maybe you have one of those. Let me know in the comment section below if you have Enterprise Product Partners in your portfolio. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community, building a community of like-minded dividend growth investors so we can share our experiences. I do stock pick of the day videos like this Monday through Thursday where we're looking at companies to see if there's any value there. I do a portfolio update every Sunday. So again, if you're interested in that kind of content, if you are a dividend growth investor, hit that subscribe button down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. So if you have a company like Enterprise Product Partners you'd like me to cover in the Stock Pick of the Day series, drop it down below and I'll work into the rotation. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and gains money. You should never invest in any amount or completely. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice of a certified financial advisor.